Hey everyone, welcome back to the channel. So for last week, I've been away because I have exams to do. But now that I'm done with exam, I'm ready to jump back in and start making videos again and really want to focus on the fundamentals. And today we're going to be talking about one of the most useful, powerful, and also complicated account, which is the Registered Disability Saving Plan. Now by here, you may be tempted to turn off the video because you're saying, I don't have disability, I don't need to know about this. While that is true, you may know someone that have disability or know someone that have family members with disability. And the truth is a lot of people in Canada with disability actually qualify to use this account, but they don't even know they qualify, so they never apply for it, they never make use of it, and they're losing out a lot of government grants, bonds, and also growth opportunity. So if you personally don't need to use this account, but if you know someone that may or may not qualify, what you can do is help us share this to them or on your social media platform. We have made a pretty good summary video with some tips and tricks at the end to really teach you how you can maximize the benefit from this account. Now, before we jump into it, if you haven't already, make sure you help us like and subscribe to the channel and also join our private Facebook group where we have almost 5,000 members and can get extra contents and ask questions inside. We have posted the link in the description below. Alright, without further ado, let's jump into today's video. Us right here, let's just start with the basics of RDSP. Now, the Registered Disability Saving Plan is basically a saving plan for people with long-term disability. Like all registered investment, all growth inside is tax sheltered. The idea with this account is really to allow family to grow the RDSP to a substantial amount to fund the beneficiary's retirement starting at age 60. Reason why is because people with disability probably have little to no CPP by the time they retire, so this RDSP would be a very nice substitute for that. Now keep in mind, even though it's intended for age 60, we can definitely make early withdrawal, which is something that we will be discussing in part 2. So one of the biggest reasons you want to open an RDSP is for the very powerful government matching benefits that you get from contributing into it. Now the matching will be different depending on your income, but for 2022, if your family net income is $98,000 or below, for the first $500 that you put into an RDSP each year, you get 3 times the match. So if you put $500 in, the government matches $1,500. For the next $1,000 that you put in, you get twice the match, so $2,000. As you can see, a $1,500 contribution can net you $3,500 matching, making your total amount in the RDSP $5,000 for that year. This is an extremely generous match. Now, if your family net income is above $98,000 for 2022, you still get some match, but the match is only going to be 1-to-1 for your first $1,000. So if you put in the same $1,500 like the first example, here only your first $1,000 will get a 1-to-1 match, making your total account $2,500. Still is a really good matching. Keep in mind that the max matching you will get from government is $70,000 in total, and beneficiary can get this matching before they turn age 49. Now on top of that, if you're a low income family with an RDSP, the government is going to go even one step beyond to help you out. They are going to give you another thing called Canada Disability Saving Bond, which is going to be $1,000 per year. Now for this, you don't even need to contribute anything. You simply need to have an RDSP account and they will deposit this $1,000 into your account. Now, as you see on the graph, even if you don't hit the low income threshold but just slightly above, you can still get partial bonds from them. The max bonds you can get in total is going to be $20,000 per beneficiary, and like before, you can only get this before the beneficiary turns 49. Also keep in mind that you can only contribute a total of $200,000 during the lifetime of the beneficiary inside this plan. Now you can also roll over other registered account into an RDSP, which is also something we'll talk about later on. Lastly, another thing to keep in mind is when the beneficiary is a minor, the family net income will be depending on the parent's family net income. But the moment they turn into an adult, their family net income is just on their and their spouse or common law's combined income, which later on we'll talk about and we can see in the tips and tricks. It can make a huge difference to get you more grants if the parents have too much income to qualify for the max matching. Now, one last thing to keep in mind is that you can actually retroactively get back 10 years worth of grant that you missed. The max timeline is 10 years and the max amount of grant you can chaseback are $10,500. So moving on, let's talk about who can open an RDSP. Now, to be able to open an RDSP, the beneficiary has to be eligible for disability tax credit. The only exception is if you are transferring an existing RDSP to a new RDSP. Now, on disability tax credit, I'm not going to go into super detail, but to qualify for it, you need to have physical or mental function impairment that is severe and prolonged. I have provided a link directly to the CRA site explaining what that means. However, one thing I do want to point out here is that in Canada, a lot of Canadians actually qualify for DTC, but they don't know that they qualify, so they simply do not apply for it. I've read somewhere the stats are something like 20 to 30%, which is a very, very high amount and a lot of money that they are missing out. Which is why in the beginning of the video, I've said this: if you know somebody in your family or a friend that have disability, ask them, hey, do you know about this thing called disability tax credit? And have you ever tried applying for it, and do you know if you qualified? Just know that they can retroactively claim back 10 years worth of DTC if they were qualified during those years. So other than being eligible for DTC, beneficiary also has to have a valid SIN number, have to be a resident of Canada, and also have to be under age 60. The only exception again is if you're transferring an existing RDSP to a new RDSP. Keep in mind that each beneficiary at all times can only own one RDSP. And also anyone can contribute to this RDSP as long as the plan holder consents to it. Now next, let's talk about RDSP limits, transfer, and also rollover. There are no annual contribution limit to an RDSP, there is just the 200,000 lifetime contribution limit. Now this 200K also includes any transfer or rollover from other registered accounts. So first, let's talk about transferring an RDSP to another RDSP. You can transfer one RDSP to the other only if the beneficiary of both plans are the same person, all holders agree for the transfer, all funds must be transferred, you cannot have partial, the current RDSP must be terminated following the transfer, and if a transfer were to happen after the beneficiary turns 59, new plan issuer agrees to pay any disability assistance payment, which is withdrawal, required to be made. Under different circumstances, family member may be able to roll over some of the registered accounts into an RDSP. For death that is happening after 2010, a deceased can roll over their RSP into an RDSP of a financially dependent and disabled child. And also, if a beneficiary is no longer qualified for the DTC, for example, because they have recovered, they're no longer severely disabled for prolonged periods of time, the rollover must be done before the end of the 5th taxation year. Now, you can also roll over lump sum from your registered pension plan, specific pension plan, or pool pension plan as well. Now, lastly, keep in mind that the rollover will count towards your $200,000 of lifetime contribution, but this rollover will not attract any grants, so there will be no matching. Alright, so those are the basics. As you can see, this is a very, very powerful tool and account with a lot of generous matching and bonds. I would say that as long as you qualify, you should definitely consider opening an RDSP, at least for the bonds if you're lower income, and also think about contributing at least up to the maximum matching per year, so you really get the biggest benefit out of this account. Now moving on, let's fast forward to the next chapter and talk about when we actually need money and withdrawing from our RDSP, which can get quite confusing. There are several ways to withdraw. First, let's talk about an early withdrawal. Now, anytime you withdraw money from the plan before the beneficiary turns 59, this is considered an early withdrawal. Since the plan, like we said in the beginning, it's meant for someone to fund their lifestyle once they pass age 60, if you do any early withdrawal, there will be some penalties. This penalty is called the 10-year repayment rule, which means that if you do an early withdrawal, if there is any grants or bonds received within the last 10 years, you will have to pay some of these grants and bonds back before you can make withdrawals. The rule is that for every $1 that you draw, you have to pay back $3 of grants and bonds that's been paid for the last 10 years. Keep in mind that even if it is retroactive pay from over 10 years ago, but paid within the last 10 years, it still counts as part of that 10-year rule. So as you can see, the penalty is actually quite hefty, especially if you were in the higher income and you were only getting a 1-to-1 match Early withdrawal in this case can actually hurt you quite a bit because now you will be paying back multiple years of grants that you'll be receiving. This is also why we said before, grants and bonds are only given to you up to age 49, so then you can have that 10-year period until 59, so then when you withdraw from there, you don't get hit with that 10-year rule. Now next we can jump to the Disability Assistance Payment, DAP. This is a one-time withdrawal that can be requested at any time. Now, when we just spoke about the early withdrawal before, that is one form of DAP. Keep in mind that you can also request a DAP after you turn age 60, but you will not be subjected to the 10-year rule. Now, if you request a DAP after you turn age 60, the amount that you can withdraw out from the RDSP depends on whether you or the government have contributed more into this plan. If your contribution is more than the government, then there's no restriction. You can take any amount out that you like. There will be no clawback, no 10-year rule. However, it is important for your plan holder to check with your local province to see if DAP's income will affect any disability benefit, since they are likely to be income tested. Now, in some provinces, this income test excludes RDSP income, but some may include them, so you better check before you make a large withdrawal. But if the government's contribution is more than your own contribution, which is much more likely if your family net income has been consistently lower than 98,000 for you to get that maximum grant for all these years, if that is the case, you simply cannot make this request. They don't allow you to make a DAP. But you can potentially get an exception. You just have to make a formal request and send the forms to the issuers of your RDSP. Now finally, the last payment you can make is the Lifetime Disability Assistance Payment, LDAP. This idea is very similar to any pension or RESP payment that you have. You can start this at age 60 and it will be a sequence of payment every year until the beneficiary turns 83. Now the payment for LDAP every year will be calculated by using your end of year value for your RDSP each year divided by how many years left it is until you reach age 85. So for example, if you're age 63, they would take the end value for last year for your RDSP divided by 20 years. That is the minimum amount that you'll be receiving at age 63. Now your RDSP issuer should be able to tell you the calculation for each year, the projected amount. But if you're curious and want to do your own calculation, I've also provided a link to an RDSP calculator. Alright, so there are two additional things you have to keep in mind when you make withdrawals. Number one is that if the government contribution is more than your own, when you make an LDAP payment, there is no way for you to change the amount that you're taking out. But if your own contribution is more than the government's, then you can request to have a higher LDAP payment if you need the money. Number two is that if there is a shortened life expectancy, you can also request for a more flexible payment. You can actually convert your RDSP into a specific disability saving plan, SDSP. Under this new account, you can make up to $10,000 per year without triggering the 10-year repayment rule. Now the SDSP will last until the beneficiary passes away or they revert back to an RDSP. Now if the beneficiary lives longer than 5 years, don't worry, there will be no penalty for this. Alright, so finally, let's talk about who pays the tax when you take out RDSP. RDSP usually consists of 4 buckets of money within the plan. They're your contributions into the plan, grants and bonds from the government, growth of the money inside, and also any rollover from other registered plans. Now, other than personal contributions, the other 3 buckets will all be taxed as income if you withdraw money from there. Income is taxed to beneficiary, so likely you guys will pay very little tax because not only that person has a basic personal amount, they also have a disability tax credit. Now keep in mind that if the total withdrawal amount for the year is over the combination of your personal and your disability amount, then there will be a withholding tax. And the withholding tax works exactly like the RRSP plan as I've shown on the chart. Alright, so those are basically everything you need to know about an RDSP. Next, let's wrap up by talking about some tips and tricks or strategies that you can employ when you're owning an RDSP. The first tip is to pay attention to your province's disability benefit requirements. There is usually an asset test and an income test to see if they really need to pay you that disability benefit. Now, RDSP is basically exempt from the asset test across all provinces, but the income may not be exempt when it comes to the calculation. So make sure you pay attention to that and plan around it before you make any withdrawals. Now, number 2 is to make contribution at least up to the matching amount as soon as possible. This gives you a much higher chance to hit that $70,000 maximum grant from the government, and also starts the 10-year repayment rule a lot earlier, so you have more grant that can skip the 10-year rule should you need to make an early withdrawal. And also obviously the tax deferred growth is a very nice thing to have on the side. Now, number 3, keep in mind that the definition of the family net income will change when the beneficiary hits age 18. Instead of looking at the parent's family net income, we look at the beneficiary's own family net income, which means that if you don't qualify for the max grant before, you have a much higher chance to qualify for max grant once your child turns 18. Now, 4th tip is to know that if the beneficiary passes away, then all proceeds of RDSP will flow to estate and be distributed according to will. Any bonds and grants for the last 10 years will also need to be paid back. And also the RDSP account must be closed before the end of the next year following the death of the beneficiary. Tip number 5 is that remember, since RESP can roll over to RDSP as well, if your budget allows to contribute to the max amount, it may be beneficial for you to open both accounts just so you can get maximum grant for each account, so then it lets you grow to a bigger lump sum over the years. Do keep in mind, if you roll over an RESP to an RDSP, you do have to pay back all the grants and bonds that you've been receiving inside your RESP. Now, for the last tip, I want to mention the idea of a Henson trust, which is something I want to make a separate video on because this can get very complicated. But essentially, if you want to leave your net worth for your kids who are disabled and have an RDSP account, but you worry that by leaving so much to them, they're going to fail the asset test when it comes to disability benefit, you should open a Henson trust instead and roll your estate into this trust to prevent any loss of disability benefits in the future. Like I said, I'm going to make a separate video on this. It can get very complicated, but you should keep this in mind if you're in this boat looking to do some estate planning for a disabled child. Henson trust is something you should definitely bring up to your lawyer or your planner. Alright, so that's everything I want to share about RDSP. It is a very powerful account, but I feel like it can get very complicated as well. I want to make sure I summarize everything, I simplify everything so more people can make use of this program and this tool. Now, if you like everything I'm sharing today, make sure you hit the like button once. If you don't like them, hit the dislike button twice. Next one I hear from you is, do you know any tips and tricks regarding disability, RDSP, or disability tax credit? If you know, let me know in the comment down below. And if you like these kind of videos, I upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel. Hit the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!